Investing doesn't have to be complicated. In fact, some of the most effective strategies are also the simplest, requiring minimal time, effort, and mental bandwidth. So let me show you 6 of the best lazy investment portfolio strategies, ranked from the easiest to maintain to those that require just a bit more work. And hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. Ranked number 1, best investment portfolio strategy, the target date fund strategy. I would say target date fund is the ultimate lazy investor's portfolio, thus ranked number 1 on my list. Here's how it works. You select a fund with a year in the name that aligns with your expected retirement date. For example, if you plan to retire around 2050, you would choose something like the Vanguard Target Retirement 2050, VFIFX. And because these funds are what is known as fund of funds, they hold several funds within them to provide broad diversification across US stocks, international stocks, and bonds. Let's take a look inside a target date fund like the Vanguard Target Retirement 2050. What we find are about 53% in a total stock market index fund, 37% in a total international stock index fund, about 7% in a total bond market index fund, and about 3% in a total international bond index fund. However, what makes this strategy so elegant is the fact that this allocation won't stay like this forever. Because of something called the automatic glide path, while early on, the fund invests heavily in stocks such as right now about 90%, as the fund approaches its target year, it will gradually shift towards more bonds and cash equivalent to reduce risk. And the best part? You don't have to lift a finger. The adjustment is done for you behind the scenes. Let me specifically break down a few of its key benefits and why I ranked it as number 1 lazy investment portfolio strategy. 1. It provides automatic asset class diversification. With most target date funds, you're not only exposed to US stock market, but the international stock market, as well as the bond market, both domestic and international. 2. It is designed for the long haul. With automatic glide paths that adjust over decades, they're built to guide you from early investing years all the way through retirement. No need for asset allocation management or the need to change strategies as you get closer or into retirement. It's all built in, which leads to a third key benefit. 3. It is designed for the ultimate one decision simplicity. You only need to make one decision in your whole investing career. Pick your retirement year. Then the fund handles everything else, including diversification, rebalancing, and adjusting risk levels as you age. It really doesn't get any simpler than that. However, it's not all roses and unicorns with target date funds. Just like anything in life, there are always downsides. Let's review some here. 1. Glide paths are not customizable. These funds follow a general model for risk reduction, but they don't consider your specific financial situation. Some investors may find the shift to bonds too early or too late. Additionally, if you want to tweak your asset allocation or add another investment, you'll need to go outside the fund. 2. It can lead to investment muscle atrophy. While being hands-off is great, but too much hands-off, if taken too far, can be dangerous. With these target date funds, you're really giving up a lot of control to the fund itself, what to invest in, level of allocation, and the timing of adjustment. And when you don't understand how or why the fund shifts over time, you risk losing touch with the basic investing principles, which can make you vulnerable if time ever comes where you need to manage your own portfolio. However, despite its downside, in a world full of financial complexity and noise, the target date fund stands out as an amazingly simple, hands-off strategy that will work for the majority of people out there. Ranked number 2, best lazy investment portfolio strategy, the one fund total world stock market portfolio. This strategy is the closest thing to owning the entire world economy in a single fund, making it one of the simplest yet most globally diversified way to invest. Here's how it works. You invest in just one world stock market fund, typically something like the Vanguard Total World Stock Index Fund, VTWAX, a fund that automatically gives you exposure not only to the US stock market, but the international stock market as well. For example, when we look under this one fund, we find this. About 63% invested in the US companies, and about 37% invested in the rest of the world, represented by Japan, UK, China, Canada, and many more, totaling approximately 40 countries and thousands of companies that span both developed and emerging markets. Overall, for someone who wants one globally diversified stock fund, the one fund total world stock market portfolio is about as lazy and as efficient as it gets. Let's break down the specific benefits and why I ranked it as a number 2 lazy investment portfolio strategy. 1. This strategy provides you with the ultimate global equities exposure. Most of these funds hold thousands of companies from across many different countries, from Apple and Microsoft in the US to Nestle in Switzerland and Toyota in Japan. Your portfolio truly spans the globe. 2 is market cap weighted. Allocation between the US and international market adjusts automatically as the market shifts. If the US companies outperform, the US weight increases. If the international market grows more, they take a bigger share. And again, the best part, you don't have to do a thing. 3 is again the one decision simplicity. If you want ultimate simplification as well as a wide exposure to the global equities market, this one fund will do that for you. Super easy. But of course, like anything in life, there are still downsides to consider. 1. No bond exposure. This is an all-stock portfolio, which means it can be volatile, especially in bear markets. If you're closer to retirement or have a lower risk tolerance, this could be considered very aggressive as a standalone solution. 2. Limited flexibility, especially between the US and international exposure. You can't control how much is invested in US versus international stocks. It's all determined for you based on the index and the market cap. For example, if you want more exposure to the US market or less to the emerging markets, this strategy does not allow for that level of customization. If you're someone who likes to fine-tune your global equities exposure, a 2-fund strategy with 1 fund for US stocks and 1 for global stocks excluding the US could work better. In talking about all these different investment options, I'm sure some big thoughts that are on top of your mind are these. What is best for me? What will best work in my situation? I still don't understand. Well, if you have these questions, I have an exciting news I want to share with you. A program that is near and dear to my heart, specifically to support individuals like yourself. Introducing the Financial Tortoise community, the ultimate roadmap to mastering your money, systematizing your finances, and securing your family's financial future. I created this community because I know firsthand how overwhelming personal finance and investing can be. In today's fast-paced world, you're bombarded with so much information when it comes to money. Get-rich-quick schemes, conflicting financial advice, and confusing investment strategies that make it harder, not easier, to know what actually works for building real wealth. That is where the Financial Tortoise community comes in. Inside the community, you'll get a clear structured path to building lasting wealth, built around simplifying, systematizing, and streamlining your finances for the long term. No unnecessary complexity, no hype, just proven practical strategies that work. Plus, as a member, you'll have access to something truly special, one-on-one time with me. Direct personal support where you can ask your most important financial questions, get a personalized financial plan, and have the confidence that you're moving in the right direction. Whether you're confused about how to allocate your investments, overwhelmed by all the financial advice out there, or just want clarity on your next steps, I'll be there to support you every step of the way. But that is just the icing on the cake. On top of the one-on-one time with me, you get so much more when you join. Member-exclusive courses, step-by-step video lessons on developing the right money mindset, demystifying investing, automating your finances, minimizing taxes, and more. These courses are designed specifically for slow, steady, long-term wealth builders like you. Monthly live Q&A calls, live group coaching sessions where we dive deep into financial topics, answer your questions, and help you stay on track towards your financial goals. Private community forum. Connect with other like-minded, hard-working professionals like yourself. Share your wins, ask questions, and build relationships with people who are on the same slow and steady journey as you. Tools, templates, and resources. Access ready-to-use financial tools, templates, and resources built to simplify your decision-making and make managing your money easier. And instant access to all updates. Get immediate access to all new training, tools, and features as soon as they're released, with no extra charge or hidden fees. Every update is included as part of your membership. The Financial Tortoise community is not just another program, it's a place to transform your financial future with intentionality and simplicity. Many have completely transformed their financial lives, and you can too. With the right guidance, a clear plan, and consistent action, lasting financial freedom is within your reach. You deserve it. But a quick heads up, to ensure that every member receives the best experience possible, I only open enrollment a few times a year. So if you want to be the first to know when the doors open again, make sure to join the waitlist today. Just head over to financialtortoise.com community or click the link in the description below. And as a bonus for joining the waitlist today, you'll receive a free special gift delivered straight to your inbox automatically just for signing up. I would love to see you inside. Alright, with that said, let's get back to the video. Rank number 3, best lazy investment portfolio strategy. The one fund total US stock market portfolio. If you're comfortable focusing solely on US stocks, this strategy is about as simple as it gets. You invest in one fund that gives you exposure to virtually the entire US stock market. A good example will be a fund like the Vanguard Total Stock Market Index Fund, VTSAX, my personal favorite. When you invest in a single fund like the VTSAX, you're essentially getting exposure to the entire US equities market. Large cap, mid cap, small caps. Approximately 4,000 publicly traded US companies in all. This strategy was popularized by J.L. Collins, the author of Simple Path to Wealth, and it has been a foundational investment approach for many in the FIRE, financial independence retire early community. And it's especially appealing to young investors who have long time horizon and can handle greater risk in exchange for long-term growth. Let me break down why this ranks number 3 on the lazy portfolio list. 1. Broad exposure to the US economy. With this strategy, you get full exposure to the US stock market. Large cap tech giants like Apple and Tesla to small cap startups, you get them all. 2. Rock bottom cost. These all US market funds are among the cheapest in the industry, cheaper than target date funds and total world stock market funds. Expense ratio range between 0.04% to sometimes even 0%. That is huge. Less fees directly lead to more of your money working for you instead of the investment firm. 3. Again, one fund simplicity. If you're fine with having just exposure to the US stock market as your portfolio strategy, when you buy this one fund, you're done. Just like the target date fund and the total world stock market fund strategy, there's no need to rebalance or make asset allocation decisions. But as always, there are a few downsides you have to consider. 1, and this one is most obvious, there is no international exposure. You're fully betting on the US economy. If the international markets outperform in the coming decades, you'll miss out unless you diversify elsewhere. 2, similar to the world stock market portfolio strategy, there is no bond exposure. This portfolio is 100% equity, which means you're fully exposed to the full wrath of the market. In a downturn, there's nothing here to cushion the fall. Still, for the investor who wants pure simplicity, low fees, and believes in the long-term strength of the US market, the one fund, total US stock market portfolio is an incredibly efficient and time-tested strategy. Rank number 4, best lazy investment portfolio strategy. The classic stock and bond 60-40 portfolio. The classic 60-40 portfolio has been the bedrock for long-term investing for decades, and for a good reason. It's built on a simple and balanced two-fund premise. Allocate 60% to stocks for growth and 40% to bond for stability. The stock portion can be represented by the Vanguard Total Stock Market Index Fund, VTSAX, while the bond side can be represented by the Vanguard Total Bond Market Index Fund, VBTLX. In an investment portfolio, bonds, because they have less volatility, usually cushion against the ups and downs of the stock market. More bonds you add to the portfolio, in theory, you reduce the overall portfolio risk. Thus, when you follow a 60-40 portfolio strategy, the idea is to get the best of both worlds. Long-term market appreciation through equities, with a buffer against volatility through fixed income. Compared to the previous two strategies that we covered so far, like the 100% equity, total US, or total world portfolios, this one steps back from the risk pedal just a bit. It's perfect for investors who still want growth, but with less emotional swings. And the structure is very flexible, and variations exist depending on your risk tolerance. For example, Scott Burns' couch potato portfolio recommends a 50-50 split between stocks and bonds, trading a little growth for even more stability. On the other side of the spectrum, Warren Buffett famously recommends a 90-10 split. That's essentially a high-octane version of the same idea. Ideal for young investors with a longer time horizon, but who want a little bit more break than 100% stock. Let's break down the benefit and why this classic setup earns the number 4 spot. 1. It provides more balanced risk and return. With 60% in equities, you're still participating in market growth, but the 40% in bonds helps soften the blow during the downturns. 2. However, you're not fixed to a 60-40 split. It's flexible and customizable. Unlike a target date fund or a total market fund, you can tweak the mix to match your personal comfort level. 50-50, 73, 90-10. You have more levers you can play with, and it's all up to you. And 3, it is still quite simple but powerful. You only need 2 funds to create a highly effective long-term portfolio. It's great for people who want a bit more control than a target date fund and a bit more stability than a 100% stock market fund. Now on the flip side, let's talk about some downsides. 1, it requires a bit more involvement. You'll not only need to come up with your ideal asset allocation between stocks and bonds, you'll need to manually rebalance your portfolio over time to maintain your desired allocation. Now, this will probably take no more than a few hours of work a year, thus not a deal breaker, but a bit more effort than a one-fund solution we discussed so far. 2, bond returns relatively low. If you're a young investor with a long time horizon, bonds, while it helps with the volatility, could hamper your long-term growth. I've seen many young investors, in the name of risk management, overexpose themselves to bonds early in their investing career and thus lose out on a lot of the gains. Now, if this was done on purpose, no problem. The issue is when a 25-year-old blindly follows a 60-40 portfolio in the name of risk management. Still, for investors who want a balanced, time-tested approach that doesn't demand much maintenance, the classic 60-40 stock bond portfolio and its cousins like the 50-50 couch potato or the 90-10 Buffett version remains a great option. Rank number 5, best lazy investment portfolio strategy. The Bogleheads 3-fund portfolio. If you've ever spent some time on a personal finance forum, the chances are you've heard of the Bogleheads 3-fund portfolio. It's one of the most beloved strategies in the world of DIY investing, and for a good reason. This strategy essentially takes the 2-fund strategy one step further by adding a third element, an international fund. An example of it will look like the following: 50% in a total US stock market index fund, 30% in a total international stock market index fund, 20% in a total bond market index fund. The US stock fund gives you exposure to American companies across all market caps. The international stock fund adds diversification across developed and emerging markets. And the bond fund reduces volatility and helps balance risk. Alright, let's summarize the specific benefits. 1. It provides broad asset class diversification. The makeup of this strategy is actually very similar to what you would find in a target date fund. You not only get exposure to the US stock market, but the international stock market as well as the bond market. Essentially, every investable corner of the world. 2. However, unlike a target date fund, it's highly customizable. You can tailor the stock to bond ratio or the US international exposure based on your personal risk tolerance and goals. And you can adjust this based on different investing phases of your life. And 3. It's backed by one of the most respected investing communities, the Bogleheads. The Bogleheads, inspired by Vanguard founder Jack Bogle, built this strategy to reflect the best evidence-based investing. Keep it simple, keep costs low, and stay the course. Why recreate the wheel when someone's already done all the hard work, right? So with all the great benefits, why is it number 5 on this lazy portfolio ranking? Because with more pieces comes more responsibility.
Remember, with great power comes great responsibility.
Let's get into the downsides. 1. More moving parts. Compared to a 1-fund or 2-fund strategy, there's just more to manage. You not only have a bond fund now, but you have an international fund as well. You'll need to make asset allocation decisions, rebalance, not to mention maintaining discipline. More human elements into the picture, more room for emotion, and more room for mistakes. And 2, on the opposite end, there is analysis paralysis. For someone just starting out, when faced with a 3-fund portfolio, deciding on the perfect mix between the 3 funds could be intimidating. It could lead to overanalysis and overthinking, and worse, lack of action. However, despite the downsides, I still feel the Boglehead 3-fund portfolio is a great balance between simplicity and control. It is still very much a lazy portfolio, but just lazy enough to require a little bit of caring and feeding. Alright, moving on. Rank number 6 and last on the best lazy investment portfolio strategy. The Ferri Core 4 portfolio essentially takes the Boglehead's 3-fund portfolio and adds a 4th component: real estate via the Real Estate Investment Trust, or REITs. Here's how the portfolio looks: 48% in US Total Stock Market Index Fund, 24% in International Stock Market Index Fund, 20% in Total Bond Market Index Fund, and 8% in Real Estate Investment Trust, REITs. The first 3 pieces are similar to the Boglehead setup. The 4th, REIT, introduces exposure to income-producing real estate. Think properties like single-family homes, office buildings, apartment complexes, and even data centers. And the thought here is that by adding REITs, you're gaining exposure to a different asset class from stocks and bonds. There have been times in history when real estate, represented by REIT in this case, have behaved differently from stocks and bonds. But of course, that added exposure comes at a cost. One more moving piece. Alright, let's talk about the specific benefit with this strategy. 1. Greater diversification. By including real estate, you're spreading your risk across more asset classes. This helps reduce reliance on just stocks and bonds to carry your portfolio. 2. Potentially higher income. REITs are legally required to distribute 90% of their taxable income as dividends. This makes them especially attractive for some income-focused investors. And 3. Fully customizable to your comfort. Like the 3-fund strategy, you can dial in your asset allocation based on your own preference. Some investors go 10% in REITs, while others go up to 20% or more. Now, let's talk about the downsides. First, as mentioned earlier, one more thing to manage. Compared to the 3-fund portfolio, the strategy introduces another fund to rebalance. It's not difficult, but it does require a little more monitoring and intentionality. 2. Tax efficiency matters. REIT dividends are taxed at a higher rate in a taxable account, primarily taxed as ordinary income. So if you're holding this portfolio outside of a retirement account, you'll want to think carefully about asset location. Bottom line, while the Ferri Core 4 portfolio is still relatively simple, it's not as hands-off as the other strategies that we covered so far. However, if you like the idea of having some real estate exposure to your portfolio, this is definitely one you want to check out. Alright, that was a lot that I covered, so thank you for sticking with me. And in the theme of investment portfolios, if you want to learn more, please check out my video where I run some interesting backtest experiments in some of the most popular investment portfolios, including the few that I covered in this video. Until next time, all the best.